Thanks very much. It's been a very exciting time to work in real estate. Here based in the UK, it's been a pretty dirty word, as just mentioned. We've been on the news at 10. We've been on the front pages of the FT. So if you run a UK real estate fund, it really hasn't been fun in any sense. And I think Brexit has provided everybody in the UK a fantastic opportunity to just reconsider your real estate investment. And I think that's really what my purpose is here today, is just to make you think about diversification. And so with that in mind, I just want to show you a very quick video, because we're trying to do something very different with this real estate fund.
If you have a city that is prosperous, money is being spent. That's what we look for, that's what we like. And that goes to the very crux of what we think. There will be winners and losers. We're here to pick the winners.
A number of countries around the world and the governments that run these countries are going to realise the global cities that are in their country are vitally important, not only to their own economy, but to the global economy.
So there you go. It's dramatic. It's a Hollywood movie trailer. It's exactly what you would expect from real estate, and it's slightly different to see fund managers in a sort of a movie like that. It's slightly different to see fund managers wearing so much makeup. But we are a different real estate fund, and the clients in our fund, 8.5% of our fund had a very bad Brexit. The other 91.5% had a very good Brexit, because we weren't invested in London. We were in many other cities around the world, and that's the key thing. It was just made reference just in the talk before about psychology, and one of the obvious things about portfolio construction is diversification. And I'm sure all your clients diversify their equities holdings globally. And I'm sure they all diversify their fixed income holdings globally. But when it comes to real estate, and this is the same wherever you are in the world, it's quite strange. People have a raw emotion to their domestic market, so they tend to over-allocate. There is no economic rationale to do that. And I think Brexit has really rammed that point home, and I think that's a very important lesson for us all, and I'll sort of talk about that a little bit further. So global cities, so we're trying to do something different here. We think it's very important that you should firstly invest in real estate, but we think when you think about where you're going to invest, we think there's a very obvious answer to the type of returns that you're trying to access and get exposure to. We think that when you invest globally, you should go straight to the strongest economies around the world. And so here's another sort of slightly strange thing, just to try and sort of make that point. So I'm just going to press play on this video, or the guys at the back of the room will. So this is Foursquare. This is the electronic pulses from people's phones in Tokyo as they go about their daily commute. It's sort of midday now as we get into the late afternoon. And these are just users who've downloaded this Foursquare app onto their phone, and as we see them going about their business. But in terms of, for me as a real estate investor, what is the relevance of this? Why am I showing this bizarre thing to you in a real estate talk? Well, the point is, and it says it's 2 a.m. in Tokyo now, just so you know, all the Foursquare users have gone to sleep now. But in terms of, for me, what that signifies for me, what the most relevant part of that is, and it's the same for if I showed you the Foursquare users in New York, in Hong Kong, in Sydney, is that there is a centre of Tokyo where sees constant activity 24 hours a day. And so therefore, if I can own real estate in that part of the city, I'm going to be able to have a better chance of charging a higher rent to the restaurant, to the bar, to the office, to the doctor's surgery, whoever it is, if I own real estate in the centre of that city, because that's where the activity is. And that should be irrelevant of what's going on with Abenomics, irrelevant of what the Fed does, irrelevant of what Brexit does. If you own real estate in the centre of a city, you're going to have a better chance to charge that tenant a higher rent. And that is exactly the type of real estate we want to own. We want to be invested in a part of the real estate world that increases the rent they charge each and every year, so that I, as a shareholder, get a higher dividend each and every year. And that's what we're looking for. We're looking to try and avoid at all costs the bond proxy. Because if the world changes, if interest rates go up, as strange as that might sound, then you're going to be in trouble if you're invested in a part of the real estate world which just simply has a very long income stream with no ability to increase that rental payment. So moving on from Foursquare and the electronic pulses from people's phones, maybe just to something a little bit more traditional in terms of real estate analysis. What is the key determinant of total return from real estate? Well, let me start by showing you GDP. So this is the GDP from the UK from the late 1980s. And if I overlay the total return from real estate in the UK over the very same time period, you'll understand why I think of GDP as the drug of the real estate sector. You look at it, the lines are almost exactly the same. And it makes complete sense. In an expanding economy, companies are demanding more office space, people are getting paid more, they're spending more in shops, in shopping centres, retailers, restaurateurs are demanding more space, etc., etc. So when you think about Brexit, when we think about what's just happened, and we think about the GDP forecasts that the IMF think will occur, that the Bank of England think will occur, and the Citi's top 30 economists, you can just see there circled in red what they think will happen to GDP in the UK. So therefore it makes complete sense to me when you read about the open-ended funds in the Financial Times on the front pages, or you see that funds have been suspended on the news at 10, it makes complete sense to me that investors in those funds are saying, okay, the world has changed, the return I thought I was going to get from these funds is lower. I think I can probably get a better return elsewhere, so I'm going to take my money out. So when you look at that GDP forecast, we know what will happen to the return from real estate in the UK. It's going to be lower. It's going to be tougher for everybody. It's going to be tougher to charge a higher rent, so therefore, as a shareholder or as an investor, your return is going to be lower. So that is why, for me, GDP is so important when you are investing in real estate. So therefore, for me, I have a global mandate. I can invest anywhere in the world. And if I look at GDP forecasts for certain countries, these are Oxford Economics forecasts, cumulative over the next 10 years. So you can see China looks particularly strong. The US looks pretty good as well. When I look at those GDP forecasts, I can't actually buy a portfolio that just gives me perfect representation across China. I can't do it across the US. But what I can do is I can find companies that have assets solely in certain cities around the world. And what's interesting to me, and what for me really makes this global city strategy so interesting, is that when I look at the various cities in those countries and their GDP forecasts, they are stronger than the countries they are located in. They're stronger than the regions they are located in. So therefore, for me as a real estate investor, thinking of that drug I've got to get hold of, I've got to go to these cities, because that's where I'm going to have a better chance to be charging a tenant a higher rent, whatever goes on with the Fed, whatever goes on with Brexit, or whatever Abenomics does for Japan. And so for me, global cities is so important because it's where the economic growth is. And I can pick various cities around the world. I don't need to just be invested in London. I don't need to just be invested in the UK. It's about investing where the growth is, where people can get charged a higher rent, and I benefit as a shareholder. So how do we determine these winning cities? So we have a Schroders Global Cities database, and we rank over 700 cities around the world, and we're trying to find the winning cities, and we're trying to avoid the losing cities. And we do this looking at 5 factors, and don't worry, I'm not going to kind of ask you to read what's on the screen from the back of the room. I'll tell you what those 5 factors are. But we've got disposable income, we've got GDP, we've got retail sales, we've got population, and then working population. These 5 factors we score and look at the forecasts over 10 years, and we then aggregate all the scores, and we then have a ranking so that we can say Shanghai is number 1, New York is number 2. Before Brexit, London was number 4. It's since fallen to number 10 with our GDP, with the new GDP forecasts that we think will occur in this weaker economy. So for us, London is still relevant. It's not as relevant as it was, but it's still a top 10 global city. So when I look at those 5 factors and I'm looking to try and find the winning cities, where is my return going to be the strongest? I really want to look at the leading cities around the world. And in our fund, we talk about the top 30. So if you just press play on this video, I'm now going to plot on the map the top 30 cities, and you'll start to get an idea of the markets that look interesting to me and roughly where my portfolio is invested at the moment. All of those cities get a score. So Los Angeles is ranked number 7. All of those 5 factors I mentioned gets a score out of 10, which helps me understand whether Los Angeles is a winning city or a losing city. Paris ranked number 13. The disposable income score, for instance, is 7.5. Tokyo is ranked 15. Its disposable income is slightly lower. So each city has a place in our database for a reason, and that helps us understand the type of return we are going to get from companies that hold assets in these cities. So moving on, where I want to go next is using Google Earth. Now, I don't know if any of you guys have seen Google Earth before. I don't know if you've been on any Google Earth flights, but I'm not sure whether Richard at the beginning pointed out where the emergency exits are, so it's probably just best just to make sure you know where the exits are and make sure your trays are in the upright position and good things like that, because we're going to go on a Google Earth flight. So I'll just press play on this on the next slide, and hopefully we'll go to Google Earth. Here we go. So just flying from the heart of the West End of London, we're going to go over to America. So has anyone been to Boston before? A few people. Okay, well, boring for you. You've seen it before, but we're going to go to Boston, so apologies. So Boston for us is a very important part of our portfolio. We really believe it is one of the key and top 30 global cities from around the world. And I think that for me, there's a few very interesting companies that own assets in Boston, and it's a great global city that should try and highlight the type of exposures we're looking for and why we want to pursue this global city strategy. So you can just see Boston coming into view at the top of the screen there. I think it's quite interesting about Boston. It doesn't necessarily get the airtime of a New York or Los Angeles, but for us it's as important. Right, so here we are. So this is Boston. So firstly, the thing that strikes me about it is we've got great infrastructure. We've got the port, we've got the airport. Another great thing about Boston, similar to other global cities, whether it's Hong Kong or the West End of London with the conservation area, is there is a natural constraint on space. You've got the water. You can see the national parks surrounding the city, which limit that sprawl. Because obviously, one of the things that will kill a real estate market is supply. If you've got lots of supply, there's no pricing power. So Boston is a nice city. There is planning constraints which restrict that supply. Now, it's got a very diverse economy. It is crucial that we are not invested in a city like Aberdeen, which is dependent on the oil industry, or Detroit, which is dependent on the car industry. Because if that one industry, something happens to it, you are in trouble. Now, Boston has a very diverse economy, as I would argue London does, New York, and many of the global cities. But if you listen to the mayor of Boston talk, Mayor Walsh, he highlights one ingredient as being the vital thing that pulls this city together and makes it very relevant. And that's education. So you can see highlighted in red, we've got Harvard, we've got MIT, and we've got Tufts. Those three universities are in the top 10 universities in the world. Now, I gave this talk about a week ago, and somebody came up to me afterwards and says that where he lives, Tufts is actually a nightclub. It's not a top 10 leading university. So I'd just like to reconfirm that Tufts is in the top 10 global leading universities in case there's a nightclub near where you live called Tufts. So anyway, these three universities, if you look at them, sort of Harvard down to MIT across to Tufts, it's sort of a triangle. And again, if you're very sad like me and spend a lot of time in these cities doing lots of research, you'll know that this triangle is called the brain triangle. It's called the research and development capital of the world, because these three universities are doing groundbreaking research into the next generation drugs that will cure all these horrible incurable diseases that we have, and then also help us live to 150 or however old we're going to live to. So there's some fascinating stuff going on here, and the mayor thinks that this is really what pulls this city together. Now, you'll notice that there are some turquoise dots there. They are the assets of a company called Alexandria. Alexandria owns what is called life science buildings. These are the very, very technical laboratories where this research is undertaken. If you can think of any big pharmaceutical company, Roche, Glaxo, Pfizer, they have a building right next door to these universities. They are a tenant in one of Alexandria's life science buildings. And what we see here is a company that really fits what we believe are the ingredients for a great long-term real estate investment. The management team own a lot of stock in the company they're running. The balance sheet is very strong. It's got very low levels of debt. It has assets in a global city, Boston, as well as other global cities like San Diego, Los Angeles, and New York. It is supplying a very, very specialist part of the real estate world to companies where there is a very long-term demand and need for them to have this technically specified space. So for us, it ticks so many boxes. And again, just highlighting how exciting my life is. I read in the report and accounts of Alexandria that last year, the American Food and Drug Administration permitted 43 new drugs to be sold to the American public. Now, over half of those new drugs were discovered and commercialized in buildings owned by Alexandria from all the commercial and pharmaceutical companies in their buildings. So these companies, this is, to my mind, it's so much more than a real estate company. They are really providing a very specialist part that the big pharmaceutical sector needs here. Now, I mentioned just a moment ago that management of the company own a lot of stock in this company. It's one of the vital ingredients that we think means that there is alignment of interest between us as the investor and the company that we're investing in. We want to be on the same side of the fence. We want the CEO to do well when the company does well, and we want him to feel our pain if things don't go quite so well. And we think on that theme of alignment of interest, it's very important that clients ask exactly the same of us. And so Hugo and myself, who I run the fund with, we've made a commitment that every year, a quarter of our bonus goes into this fund, irrelevant of a Brexit, a Fed, an Abenomics, or any black swan event. We're putting that in every year because we believe in the companies like Alexandria we're investing in. We believe in the alignment of interest between us and the management teams we're backing, and we know that these companies have low levels of debt and they're invested in global cities, which over the long term should perform very well. So there's a very strong theme in this fund. So just moving away from Alexandria to Boston, I suppose, looking at it on a map in a different way. Now, you might just be able to make out there are some university hats. So this is Boston again, but just shown in a different format. We've got the universities with the hats this time. Alexandria's assets are the dots on the screen. But if you press play on the video, what I'm now going to show you is all the other types of companies that we have exposure to in Boston. Boston properties are the orange dots. These are mainstream office buildings that you and I would work in. The green dots are equity residential. So if your job is in Boston and you can't afford to buy, you're going to rent. You'll probably rent from equity residential. As we zoom out and see a bigger picture from the city, you'll start to see many other colors of dots. We've got shopping centers. We've got logistics facilitating that last mile of delivery from Amazon. We've got self-storage. We've got healthcare. We've got every little thing is part of this city that is growing. We have tentacles in so many pies, and that's exactly as it should be for any global city. Because the reason why a city is a global city is because it is growing. It has many different industries. And that's what's key for us, is the vibrancy and growth of a city. So it's never going to just be about Alexandria and life science buildings. It's going to be about all the different parts of that city which are growing, and we want to try and get exposure to it. So Boston is just a great example, but we have similar examples in terms of the diversified exposures across all the global cities in our portfolio. So when I show you what the portfolio looks like, you start to get a feel for that diversification. You can see the global cities around the world. We don't think about this portfolio that it has 3% in Australia. We think that there's 2% in Sydney and 1% in Melbourne. And we think that both those cities are very relevant. We think they will both continue to grow. And we've got great companies in the portfolio giving us exposure to those cities. Similarly, you'll notice that London is the single largest city investment in our fund. Now, if I was showing this to you on the 23rd of June, it would have been very similar to Tokyo, which is the orange bar coming in around 8%. But the dark days after Brexit, we saw the listed market reacting very, very viciously and pessimistically to companies with exposure in London. And we saw that as a very interesting buying opportunity. Much the same as in those days after Brexit, Hugo and myself as fund managers actually increased our investment in the fund. And it'd be interesting whether, if you talk to any of the UK open-ended fund managers, whether any of those guys increased their investment in their fund post-Brexit. I would suggest that they probably didn't. But for us, companies that we have exposure to in London are companies like Great Portland Estates, or Derwent London. Great Portland Estates, for instance, has just signed a building entirely let to Facebook. These guys own assets in the West End of London, which, as I mentioned earlier, is a conservation area. We're not holding buildings here. We're not holding companies that have assets in the city or in the Docklands, which will be affected by Brexit. We're in the West End, where the key tenant base is the creative industries. where last week we saw Apple commit its European headquarters to London at Battersea Power Station with over 500,000 square feet. So we're not concerned about Brexit. We're able to make pretty brave decisions when the rest of the market is getting very concerned about the total return from real estate. But we think that was comfortably in the price. So again, 10% of our funds in London, but the other 90% is diversified globally. And that's been very, very important for us and for our clients over Brexit. And so again, coming back to that 101, if you like, of portfolio construction, it's not to have all your eggs in one basket. I'm not here trying to say that the UK open-ended funds are bad things and that this is a good thing. I'm just trying to say it's about balance and it's about diversification. If you look at the NEST allocation, so the National Employment Savings Trust, the government's new defined contribution pension scheme, just for your information, they have a 20% allocation to real estate, which is pretty high. But of that allocation, 70% is in the UK and 30% is in the global listed sector. Again, to give them diversification, to give them liquidity when they may need it. So I think those are quite interesting points for you to consider. If you'd like to see some more cheesy corporate videos with fund managers wearing makeup, we have a website. We give you more information about our Global Cities database. We send blogs back from the cities when we visit them. One of the recent blogs was from New York, where Ryan, our lead US analyst, went to the latest opening of a Westfield shopping centre on Ground Zero, where 300,000 people are expected to visit that centre each day. They're expecting over $1 billion in sales each year. So again, companies like Westfield, we think, are at the forefront of the e-commerce trade. We know that they will be in the shopping centres where retailers have to be, and we're worried about the shopping centres where the retailers don't have to be. So again, you get some more information from our fund philosophy and what we're trying to do and why we're trying to be different with this Global Cities Fund. So thank you. I'll pause there and maybe see if there's any questions from any of the audience. No, so what's interesting when you look at China, and if you go back to that GDP chart, China was off the charts good. It was the strongest GDP. But we have, if you like, when we're looking for stocks, kind of what we call the holy grail. There are three things. It's management alignment, strong balance sheet, and assets in a global city. Shanghai is without doubt a global city. But for us to find a company that the management team owns stock in the company they're running with a low level of debt, we can't find it. So it kind of gets a tick for global cities, across for management and across for balance sheet. And therefore, we're not prepared to put our capital at risk at this point. Now, if I'm here in 5 years' time, I think we'll probably have more exposure in China as the companies get better. Mexico may well be one of the countries Mexico City, another city that we invest in. So, we never rule anything out, but when we invest, we have to be sure. Because as I mentioned, we are invested in this vehicle ourselves personally, so we need to make sure that everyone's interests are aligned. And if we can't find that management, balance sheet, global city trifecta, we're not going to invest.
So your expectations for GDP are going down, but you've increased your allocation to London.
Yep.
Is that because tactically you just see cheap assets, or?
Yeah, it's about pricing. It's about what's in the price. I mean, there is no. We're absolutely convinced, as many are, is that the GDP of the UK is going to go down. The GDP of London will go down. My personal view is that London will be less affected than the rest of the UK, but it's not going to be good. But there is a point when valuation comes into our conversation, which is right at the end. We've found the good companies, and now we say, right, are they cheap or are they expensive? And so at the moment, we look at those London-focused companies and we are saying the market is pricing in a global financial crisis. The market is effectively pricing in rental values falling by 25 to 30%, and capital values falling by a similar magnitude. Now, we've gone back and looked over previous cycles, and that really only happens when it's a global crisis. We think this is a UK crisis, and we think that the city and the Docklands, for instance, will see very dramatic, jobs move. But I think those West End-focused companies we're very comfortable about. And we think that the risk return is in our favour. So, yeah, it's just about pricing.
Any more questions? Lady here.
Yeah, it's a great question, and this is again kind of what Brexit has done, is it's just shined a light on fund structures for real estate, and I think that it's something that really it's almost a debate we shouldn't be having, because we've seen this happen before. We've seen the open-ended funds suspended, post-Brexit. We've seen them suspended post the financial crisis. We saw them suspended in the tech crisis in 2002-03. This is not new. But it's just about people being aware of what they're investing in. And in my opinion, I think that someone might look at a company that I invest in, whether it's Great Portland Estates, it's listed on the stock market, and they might say, oh, that's an equity return, it's not real estate. And they might look at the open-ended fund that revalues every 6 months, and they'll say, that's what I want, low volatility real estate. But it's the same asset class, and just to kind of give you an analogy, so if you think of the walkie-talkie just over the river here in the city, so on the 23rd of June, one of them was held by Land Securities, and then there's a complete replica of that asset, and it's held in, I don't know, any open-ended bricks and mortar fund you can think of. So the value is the same on the 23rd of June. 24th of June, we have the vote. The listed market prices Land Securities assets down by 25%. Okay? The open-ended fund is just simply there just going, no, nothing's happened. That's exactly what they're doing, because they're not going to revalue till 6 months' time, till probably Christmas. When they get to Christmas, the valuer will then just say, right, what's the value of these assets? Have there been any comparable transactions? And the point, I think, for me is that the valuer doesn't know, the listed market doesn't know. The answer is probably somewhere in the middle, but it's just about liquidity. It's, does your client want to be in a vehicle where he might get suspended for a couple of years, or does he want to be in a vehicle where he can get out at any point? And if he made that decision to get out on the 24th of June, I wouldn't necessarily agree with it, because I'd say you're selling at the worst point, hold on, and you see it recover. But he has that option. So I just think we're talking about liquidity here. And that for me is, there is no right and there is no wrong. It's about what the client needs. And that's again where it comes to me about balance. You should probably have some in the open-ended funds if you want a less volatile, because your client doesn't want to see what the answer is and he wants it every 6 months. And then you might have some in the listed market where we just price looking forward. But the point is, it's the same asset. And that's what gets confused in this conversation. So the direction of travel is the same.
How much do you intend to retain as cash for liquidity purposes going forward?
For us, it's never more than 1 or 2%. We are invested in, going back in history, why REITs were invented is because in the US in the late 1960s, they had daily dealt open-ended property funds. They had a run on those property funds. They're now banned in the US, and REITs were invented. And so, my sector that I invest in is never going to have a high or a low cash balance because of fear of money coming in or out, because I can just give it to a client tomorrow, or if they give it to me today, I can invest it today. And so I will never have more than 1 or 2% cash in my portfolio. Whereas obviously the flaw with the open-ended fund structure is when they're having all the money, they were sitting on 20 or 30% cash levels because they couldn't find the assets to buy. And that again it's an interesting question about alignment, because if you have all this money coming in, you're then forced to buy, because no one wants to pay a fund manager to hold 30% cash. And similarly, when the money goes out, they're forced to sell. Whereas with the REIT, it's just an investment trust. And so, the share might trade at a premium or it might trade at a discount, but you always have that liquidity. So yeah, for us, cash it's always low and always will be.
Okay, we've got time for one last question. Anybody want to ask one last question? Maybe I'll ask it. Put your hands up if you actually use real estate investment trusts for your clients. The opportunity is wide open for you there, Tom.
Yeah, I think for me, REITs is, I like to think the opportunity is all open for me, that's right. But I think the thing about REITs for the UK, and I lived in Australia and worked in Australia where they've had REITs since the 70s. Every retail and institutional investor allocates to REITs and to bricks and mortar funds. But what was, if you like, unfortunate for the UK is that REITs were invented here or legislated in 2007. Shortly afterwards, the market crashed. So everyone was like, oh, well, if I invested in that REIT in 2007, I only got half my money back. But the reality is whatever you invested in 2007, you only got half your money back. And so that, for me, has led to, it's harder to talk about REITs because people say it's an equity-like return. But Brexit is changing that conversation. And I think that's the key thing, is that now people understand the pros and cons of open-ended and the pros and cons of REITs. And nothing is perfect, but it's about what your client needs.
Okay, ladies and gentlemen, Tom Walker, thank you very much.